Hello and welcome to the Scientific Investor series of Omniscience Capital. Today we'll talk about a very interesting topic, which is what happens when your corpus reaches 20 lakhs. There's some magic happens and we will explore that and make some pointers about it. So most people thinking investing is about the right stocks or funds, which it is, okay? But there is much more to it. But that works when your capital is small. Like what mutual fund to pick, you can just pick some mutual funds, you can just pick some right stocks, and let's say you're just doing 1, 2, 3 lakhs, then it doesn't really matter, because even if you make a wrong choice, let's say you had 2 lakhs and it made a wrong choice, then what will happen is basically you'll use 10, 20, 30,000 rupees, and compared to your income, that's okay, and you can absorb. And that is why that stage is important. First you should experiment with small amount of money, see how you feel, see what your mistakes are, etc., etc. However, now after doing this for let's say 3 5 years, your corpus is now 20 lakhs. You have also developed some confidence, you have developed the understanding of market ups and downs, and now you have a 20 lakh, and now the game changes completely. It's a significant corpus. And now if there is a 20% fall, let's say you did a mistake and there is a 20% fall, now you are making a significant amount, 20 25, you're making a loss of quite a big sum, right? You're 5 lakhs down, 4 lakhs down, and it feels the pinch. So now you cannot be doing those mistakes. Okay, at higher capital every mistake will have significant impact. So now the focus shifts from not just what to buy, and you just randomly buy a set of stocks, whatever stock you felt like, you read it in the newspaper, you did your own analysis, something, and you bought, and you didn't even decide how much. Whatever money you had, you just bought it, right? And then somebody said this mutual fund is good, whatever money you had, you just bought it. Now no longer you can do this. Now you have to have a rational, disciplined portfolio. You need a framework. Okay, so now this is what we will talk about, how this shift will happen from stock picking to portfolio construction and portfolio management. Okay, it's not about individual ideas. Oh, I like this, I'll pick. I like that, I'll pick. No, a portfolio is a system, it's not a collection of stocks. So we're talking of the framework now. Okay, the framework we will be talking, that you need a framework. And then second thing is that so far you like the idea that this stock is likely to go up, that mutual fund is going to have high returns, that's why I'm buying this. Now it's no longer like that. It is first that not to lose capital. Okay, see, we at Omniscience have this Omni insight: chase safety, get alpha. And the reason is, you don't want to lose capital. Now losing capital permanently is a big loss. Doesn't mean your portfolio will not go through ups and downs. Portfolio will guaranteed go through ups and downs, because market goes through ups and downs. There is no magic wand anyone has where portfolio doesn't go down. You might have heard of long short equity and all that. All that is there. All kinds of hedging is there. But despite that, those have other risks which come in. And even though sometimes for long periods of time a portfolio remains positive in up market, down markets, because of other asset classes or other ways of hedging or long short, but sometimes then the whole thing collapses, the whole thing blows off, and you actually owe more money. So we will not do all that. We are simple long only investors. We will talk about how to do that, how to reduce the risk, right? And we have discussed this in other scientific investing framework, how to discuss focus on the downside first. Once the downside is covered and you have taken out, for example, in the scientific investing framework, which is in some other video, you've taken out capital destroyers, eroders, imploders, etc., and then you have focused on the enhanced safety is done, then you go to enhanced growth, and then you go to enhanced returns. Somewhere in between there's enhanced quality. You can look up those ideas. But the shift is, you're shifting from return focus to first risk focus, and then the return focus. Okay, now one more shift is there. The shift is from passive investing to active investing. So you might start off with a ETF like strategy or index investing, because when you don't know anything, right, you don't even know how to pick funds. So first you start with the ETFs or index funds, which you will basically you will get what Nifty gets, right? If there is no tracking error or very little, then practically whatever, and the fees is low, whatever is the index return is your return, right? Second thing is like you have this idea that, oh, these are the 5 or 10 or 15 stocks which everyone says you should have, and these are like, I'll just buy this and like I'll hold it for 20 years. But that will no longer work. Market is not like that. That was fine long ago when market movements probably were low, which I don't know when they were low, for 600 years or 400, more than 650 onwards, when Amsterdam Stock Exchange, at least from that time, markets have never been stable. Okay, so that is the thing, and you now continuously need to, you want to know what you own all the time. So it's not like daily, but every 3 months, 6 months, you have to review your portfolio superficially. Every 1 year, deep dive into your portfolio. That is what is required. And mutual funds, ETF, SIPs and mutual funds or ETFs, all that was very good. You should start there. Once you have reached 20 lakhs, now you need to say that, okay, I need a direct stock portfolio, an active portfolio, but I need to know the scientific investing framework and manage things accordingly. It's not randomly buying things. What is the portfolio? How many stocks should be in the portfolio? How to review when new fundamentals are out every quarter? What should go out? Because if something is overvalued, it needs to go out. If the original thesis itself was dependent on fundamentals and fundamentals have deteriorated, then the company's again intrinsic value itself has changed, and then again you need to take action for that. So portfolio has to be actively managed. Doesn't mean you are churning daily or weekly or whatever. It means every quarter when new fundamentals are out, or there is some big news that some regulation changed and your fundamental of the company has changed, or market price keeps changing. So something you bought with the intrinsic value of 100 rupees, you bought it at 50 rupees. Now it's selling at 150 or 200. It's above the intrinsic value. Then it needs to go out. Otherwise, again, it will come back to intrinsic value in the long run. As Benjamin Graham says, market is a voting machine in the short term, but weighing machine in the long term. So weighing machine means it will go back to the intrinsic value. It's like gravity. If stock is above the intrinsic value, it will come to the intrinsic value. If it is below, it will again come to intrinsic value. So when it's below, you buy. When it goes above, you sell, and that's how the portfolio, and you need to replace with something else. Okay, and at least 20-25 stocks have to be in the portfolio. Diversification across sectors, industries, etc., has to be there. All that we have discussed in other videos in scientific investing framework. So you can follow us and track those, and that's how you will manage your investment capital now that you are a serious investor. So 20 lakhs is one bottleneck or milestone, and 1 crore is another milestone, which is now even more serious. So first you reach 20, next you target 1, and then beyond that again things change. Thank you.